Imagine you're tasked with building the infrastructure of the future. You need millions of electric vehicles on the road, a totally modernized power grid, just vast fields of wind turbines.
And all those sprawling data centers for AI, right?
Right, exactly. Those incredibly energy-hungry data centers. So to physically build all of that, you need raw materials. And if you trace that entire supply chain back to its absolute origin, you essentially have to drive down this single, unavoidable highway. And sitting right there at the toll booth is one company.
Yeah, and I mean, they certainly aren't manufacturing the electric cars or, coding the AI, but they are holding the raw materials that are absolutely required to make any of those future technologies an actual physical reality.
Right, which brings us to our mission for you today. Welcome to today's deep dive. We are unpacking the Q2 2026 earnings report and the investor presentation from Freeport-McMoRan.
Ticker symbol FCX.
FCX, yep. And they market themselves as America's copper champion. So our goal for you today is to cut through all the heavy corporate jargon and see how these massive global megatrends, specifically, the aggressive push for electrification, are actually showing up on the balance sheet of one of the world's largest mining operations.
It's a really critical time to evaluate a massive industrial player like this, too, because we're looking at an environment where these secular tailwinds, these long-term, just unstoppable trends like grid modernization, are completely colliding with finite physical resources.
Right.
So the challenge for us in evaluating their latest earnings is separating the structural global demand from their actual day-to-day operational execution, right? We need to see how they're translating these really high commodity prices into a sustainable long-term profit, not just enjoying a temporary windfall.
Well, speaking of windfalls, let's just jump straight into the headline numbers for the second quarter of 2026, because honestly, the sheer scale of the cash moving through this business is staggering.
It really is.
So Freeport brought in total revenue of $7.03 billion for the quarter.
Wow.
Yeah. And looking at the bottom line, their net income attributable to common stock was $984 million, which, breaks down to 68 cents a share.
Right.
But then when you look at their adjusted net income, it climbs to $1.1 billion or 74 cents a share.
And to understand the velocity of that cash generation, I mean, we really have to look closely at the realized prices for the metals they're actually pulling out of the ground, because the market environment right now is it's unprecedented.
I was totally floored by the prices in this report. I mean, they realized $6.17 per pound for copper.
Which is huge.
Huge. And their gold was selling at an astonishing $4,520 per ounce.
Yeah, that's just wild.
And then you have molybdenum, right?
Yeah.
Which is this crucial hardening element used in steel alloys. That was moving at $28.75 a pound.
Yeah.
But, okay, let's unpack this. Because looking at those numbers, my immediate instinct is to be, well, pretty cynical about management taking a victory lap here. Well, if I run a simple lemonade stand, right, and the global market price for a cup of lemonade suddenly rockets to $50, I'm going to look like an absolute financial genius on paper, even if I run the business terribly.
Right. A rising tide lifts all boats.
Exactly. So how much of this $1.1 billion quarterly profit is actually due to Freeport's operational skill versus them just, simply riding this massive, very lucky commodity supercycle?
Well, if we connect this to the bigger picture, that is the exact question every institutional investor is asking right now. You really have to look past that top-line revenue, which is obviously inflated by the broader metal of electrification trend, and focus intensely on their margins.
Okay, so what's the metric we're looking at?
The single most important metric in this report, to answer your question, is their consolidated average unit net cash costs. In Q2, it cost Freeport just $1.97 to produce a pound of copper.
Wait, I need to pause you there to make sure I'm hearing this right. They are spending less than $2 to produce a pound of copper and then turning around and selling it into the market for over $6.
That is the math.
Yeah.
That's insane.
And keeping those unit net cash costs at 1.97 per pound, that is exactly where the operational skill actually shows up.
How do you mean?
Well, think about the macroeconomic environment over the last few years. We have seen massive, just persistent inflation in skilled mining labor, in the heavy diesel fuel required to run these sites, and, in the heavy machinery itself. So to keep production costs undue dollars in that environment, that requires immense operational leverage.
Okay, but how do they actually calculate that 1.97 figure? Like, does that include everything required to get the rock out of the ground?
It does, yeah, but it also factors in a massive advantage they have which is byproduct credits.
Byproduct credits.
Right, so when Freeport digs up a massive haul of ore, they aren't just finding copper. They're unearthing gold and molybdenum at the exact same time.
Oh, right. Because they're all mixed together in the rock.
Exactly. And because they're selling that gold at record highs of over $4,500 an ounce, they take the revenue from those secondary metals and they apply it as a credit against the cost of mining the copper.
Wow.
So the gold and moly sales effectively subsidize the copper extraction. So yeah, while they are absolutely riding a macroeconomic wave, they have engineered an incredibly efficient cost structure to capture maximum value from that wave.
Okay, I see. The margins are undeniably impressive. But reading deeper into the operations, there is this massive discrepancy that jumped out at me.
The volume drop?
Yes. Despite these billion-dollar profits and, under $2 costs, the actual physical volume of copper they sold basically fell off a cliff.
Yeah, it did.
They sold 710 million pounds of copper in this quarter, which sounds like a lot, but if you look at the exact same quarter last year, Q2 2025, they sold 1 billion pounds.
Right. A 290 million pound drop in volume. That's a 29% year-over-year decline.
Which is a severe operational hit.
It is. And to understand the mechanics of that drop, we have to shift our focus over to their operations in Indonesia.
Specifically the Grasberg mine, right? Which is like a crown jewel in their portfolio.
Correct. So the Grasberg Block Cave underground mine is operated by PT Freeport Indonesia, which they often abbreviate in the report as PTFI. Now, in September 2025, that facility suffered a severe operational disruption that the company classifies as an external mud rush incident.
Which, by the way, for anyone outside the mining engineering world, an underground mud rush just sounds terrifying. But what does it actually mean for the business?
Wow.
I mean, it's a sudden, violent influx of mud, rock, and water flooding into the underground tunnels, right?
Yeah.
It forces a complete halt to operations, destroys equipment, and creates just immense safety hazards.
Yeah, it's a logistical nightmare, and the financial toll of that nightmare is heavily detailed in this quarter's numbers. In Q2 alone, Freeport had to absorb $284 million in idle facility and restoration costs.
Just in Q2.
Just Q2. If you look at the first half of 2026 entirely, those costs totaled $690 million.
Ouch.
Because the reality of mining is that when a facility of Grasberg's scale stops extracting ore, your expenses don't just stop. You still have this massive workforce on the payroll, you have to maintain the ventilation and pumping systems, and in this specific case, you have to spend hundreds of millions just clearing the mud and repairing the structural damage.
I look at Grasberg right now like a star franchise quarterback who suffered a catastrophic midseason injury.
That's a good way to look at it.
Right, like they aren't on the field throwing touchdowns, but the team still has to pay their massive guaranteed contract, plus all the specialized medical bills and, rehabilitation costs. They're stuck doing daily physical therapy just trying to get back on the field.
That analogy perfectly captures the current state of PTFI. The mine is currently undergoing a phased ramp-up, which is their version of physical therapy.
Are they on schedule?
Yeah, management indicates this ramp-up is progressing on schedule. And, extending your sports analogy, just like an injured player might have an insurance policy to cover lost wages, Freeport had pretty extensive property and business interruption insurance.
Oh, it's right.
Yeah, PTFI collected $1.7 billion, so $700 million in pre-tax insurance proceeds specifically tied to that mud rush incident.
Okay, so that $700 million definitely cushions the blow. And I guess it also explains a smaller detail I saw in the report. Gold sales were reported at 123,000 ounces, which actually missed their own April estimates slightly.
Right.
But the company cited that this was primarily due to the timing of refined gold shipments in Indonesia, which obviously all that ripples out from the Grasberg disruption.
Exactly. All those supply chain hiccups stem straight from the mud rush. And actually, this brings us back to a crucial accounting concept we touched on earlier, the difference between their GAAP net income and their adjusted net income. We noted the GAAP net income was $984 million, but the adjusted figure was $1.1 billion.
And I always struggle with this when reading earnings reports. Why does Wall Street allow companies to just create a secondary adjusted number that magically makes their profits look higher by excluding the bad news?
Well, it's a totally healthy skepticism to have, but in this case, the company excluded a $96 million after-tax net charge that was directly related to the idle facility and restoration costs from the mud rush.
Oh.
The GAAP numbers, generally accepted accounting principles, they're strictly designed to tell you exactly what happened to the company's bank account, right? They paid for the mud rush, so the profit goes down.
Right.
However, analysts and institutional investors look at the adjusted numbers because they want to isolate the core health of the ongoing business. A mud rush is a one-time disaster. It's not a structural flaw in the company's business model.
That makes sense.
So by stripping out those specific non-recurring costs, management is showing investors that the underlying economic engine of the company remains highly profitable, even while they're paying for an expensive temporary recovery phase.
Well, if Grasberg was operating severely below its normal capacity, someone else in the portfolio had to pick up the slack to still generate that $1 billion in adjusted profit. And that leads us to look at how their assets in the Americas performed during this crisis. Here's where it gets really interesting.
Yeah, because the geographic diversity of Freeport's operations is functioning as a massive operational hedge right now. With the Indonesian output constrained, the operations in the United States and South America just accelerated dramatically. The operating income from their U.S. copper mining segment was up approximately 2.4 times in the first half of 2026 compared to the same period in 2025.
Seeing a segment jump by a multiple of 2.4 is huge.
It is.
And when I dug into how they actually achieved that kind of growth, I got completely fascinated by what the report refers to as their leach initiatives. I actually have another analogy for you.
Let's hear it.
Okay, imagine you own a massive commercial lemon orchard. Over the last decade, you've paid your workers to pick the lemons, squeeze them for juice, and toss the remaining halves into a giant pile.
Okay.
Now, instead of going through the decade-long, multi-million-dollar expense of buying adjacent land, securing water rights, planting a whole new orchard, and waiting for it to mature, you suddenly invent a cheap chemical process that lets you go back to that massive pile of squeezed, discarded lemon halves and somehow extract 20% more juice out of them.
Wow. And that is the exact mechanism of leaching technology in the copper industry. Because traditional mining involves blasting rock out of an open pit, crushing it in these massive mills, and then using high energy to separate the copper.
Right.
But over decades of doing this, mines build up literal mountains of low-grade ore and crushed rock that simply didn't have a high enough copper concentration to justify the really expensive milling process.
It's basically just considered waste.
Exactly, it was waste. But what's fascinating here is what Freeport is doing now. They're deploying these proprietary internal additives, these specialized chemical solutions that they percolate through those existing stockpiles. And the chemicals bind to the trace amounts of copper left in the rock and safely carry it out to be collected.
So they're essentially mining copper that has already been dug out of the ground.
Exactly. And the unit economics of this process are incredibly attractive because the most expensive part of mining, the drilling, the blasting, and the hauling, was already paid for years ago.
That's brilliant.
Yeah, Freeport currently has heat trials for these chemical additives running at their Morenci mine in Arizona, and they're preparing to launch similar trials at the El Abra mine in Chile in the second half of 2026.
Okay, so this focus on leaching ties directly into a broader strategic shift in the mining industry regarding capital allocation, doesn't it?
It does. We're living in a high inflation era for heavy industrial construction. Attempting to permit and build a brand new mine from scratch, what the industry calls a greenfield project, is incredibly risky.
Right, because of the regulations.
Yeah, it takes 10 to 15 years just to get the environmental permits, and that's assuming you don't face insurmountable local opposition. And it costs billions before you sell a single ounce of metal.
So the alternative is maximizing the real estate you already control.
Precisely. They are executing what they call brownfield expansions. This means building new infrastructure on top of existing, already permitted mine sites. The report highlights the Baghdad 2X expansion in Arizona as a prime example of this.
Ah, yes. The Baghdad 2X. That's where they're advancing plans to transition the existing energy source at that mine from coal to natural gas, right?
Right.
And I read this project was briefly deferred due to the capital strain of the Grasberg mud rush, but now it is back on track with an estimated $150 million in capital expenditures, or CapEx, slated for 2027.
Exactly. They are also moving forward with the environmental impact statement process down with Chilean authorities for a massive brownfield expansion at El Abra.
And if they can't expand a site physically, they're just using cash to increase their ownership stake in sites they already operate. I noticed a detail where they spent $107 million on the open market to purchase 2 million additional shares in Cerro Verde, which is a major mine down in Peru.
Right. And that purchase incrementally increased their overall ownership of Cerro Verde from roughly 55% to 55.66%. buying out minority partners in an asset you already operate, in a legal jurisdiction you are already deeply familiar with, it removes almost all the execution risk.
Right.
It is a highly efficient use of capital compared to going out and exploring for new deposits in totally untested regions.
So we have a company selling essential materials into an incredibly hot market, defending sub-$2 margins, recovering on schedule from a massive underground disaster, and using chemical innovations to squeeze profit out of old rock in the Americas.
Pretty good quarter.
Yeah. But I want to pivot to the balance sheet because we need to talk about what management is doing with the sheer volume of cash this business is generating.
The cash generation metrics are really formidable. I mean, Freeport reported $2 billion in pure operating cash flow just in this quarter alone. And when you look at their overall financial health, they've built a fortress balance sheet. They were holding $4.1 billion in consolidated cash. Against that, their net debt sits at just $2.1 billion, keeping in mind that figure excludes the specific project over in Indonesia.
Okay, so what does this all mean? Because I'm going to push back heavily here on behalf of the retail investor looking at this stock.
Okay, let's hear it.
They generated $2 billion in cash in a 90-day window.
Right.
Yet, when you look at the capital returns section, they only returned $600 million to shareholders over the entire first half of 2026. Yes, that $600 million included buying back 1.7 million shares at an average price of $64.34, which mathematically increases the value of the remaining shares.
It does.
But simultaneously, they're projecting a massive $4.3 billion in capital expenditures for the year. If they are sitting on billions in cash and enjoying historic copper prices, why are they spending $4.3 billion on themselves and giving so little back to the people who own the stock?
Yeah.
Like, is Freeport just being stingy with dividends, or is there a structural reason they are hoarding capital?
Well, this raises an important question, right? It's the central tension of investing in resource extraction. You really have to understand the fundamental reality of the mining industry. It is, by definition, a depleting asset business.
Right.
Every single pound of copper Freeport sells today is a pound of copper they no longer have in the ground to sell tomorrow.
True.
If they stop investing in the physical infrastructure of the mines, the company slowly liquidates itself. So, to address your point on the $4.3 billion capex projection, management specifies that $3.0 billion of that total is dedicated strictly to major mining projects.
So they are trapped on a treadmill where they basically have to spend $3 billion a year just to keep their production numbers from shrinking.
Exactly. It's the Red Queen effect, running as fast as you can just to stay in the exact same place.
Yeah.
They have issued guidance expecting 3.1 billion pounds of copper sales for the full year of 2026. The financial models show that if copper stays flat at $6 a pound for the second half of the year, their operating cash flows will hit an estimated $8.3 billion for 2026.
Okay.
But capturing that future cash flow requires immense upfront spending today. They need to fund the complex underground mine development to fully recover Grasberg.
Yeah.
They need to fund the new natural gas infrastructure at Baghdad. And they have a very aggressive corporate target to add approximately 800 million pounds of annual copper production solely from those chemical leach initiatives by the year 2030.
Wow. 800 million pounds just from leaching.
Right, and you cannot hit a target that large 4 years from now without deploying billions in capital right now.
Okay, but the reliance on that $6 a pound copper price is a major risk factor, though, isn't it?
Mm-hmm.
The report includes a sensitivity analysis that spells out exactly how exposed their cash flow is to the open market.
It does.
For every 10-cent change in the global price of copper, Freeport's operating cash flow swings by $150 million over the course of a year.
Yeah, it is a highly levered industrial play on the underlying commodity price. I mean, a $1 drop in copper wipes out $1.5 billion in cash flow.
Ouch.
However, management has intentionally structured their balance sheet to absorb that inherent cyclicality. If you look at their debt maturity profile, it's incredibly attractive. They have very little debt coming due before 2027.
Oh, that's good.
Yeah, this long runway means they can execute these multi-billion-dollar, multi-year expansion projects without the immediate threat of creditors, forcing them into bankruptcy if the copper price suffers a temporary macroeconomic dip.
So they are essentially using this period of record high prices to widen the lanes and upgrade the infrastructure at their toll booth, ensuring that when the traffic really spikes over the next decade, they can handle the volume without breaking down.
Exactly. They are sacrificing short-term dividend payouts to guarantee they remain the dominant, lowest-cost supplier for the next 20 years. They are future-proofing the balance sheet.
Well, before we wrap up today's analysis, I want to pull back from the specific line items of this quarter and look at the macro environment this report operates within. We've dug into the mud rush logistics, the chemistry of leaching, and the realities of capital allocation. But just look at the raw prices dictating these numbers.
Yeah. We have a quarterly report reflecting gold trading comfortably above $4,500 an ounce and copper-based prices holding well over $6 a pound.
Right.
And these do not appear to be speculative, temporary spikes. They're being sustained by deep structural shifts in the global economy.
Right, so if these commodities establish a new floor at these historically unprecedented levels, which seems to be driven entirely by secular, unstoppable forces like the global transition to green energy, the mandatory electrification of transportation, and the desperate need for grid upgrades to support artificial intelligence,
Right.
you have to ask yourself a much bigger question about these companies.
Which is?
Are legacy mining giants like Freeport-McMoRan fundamentally transforming their identity in the market? I mean, for decades, these were viewed as highly cyclical, risky industrial stocks that would boom and bust violently with every minor shift in the economic winds.
Yeah, they were.
But are they quietly ceasing to be cyclical gambles and instead evolving into the foundational, indispensable infrastructure utilities of the 21st century?
It forces a complete reevaluation of how we price these assets, honestly. If the green energy transition is physically impossible without a massive, continuous supply of new copper, then the companies controlling the Tier 1 copper assets become the absolute base layer of the modern economy.
Right. If you were the only one holding the keys to the toll booth on the road to electrification, eventually, every single government and tech company is going to have to pay your toll.
Very true.
It is definitely something to keep in mind the next time you read a headline about global energy mandates or, data center expansions. And that wraps up our analysis of Freeport's quarter. If you want to keep cutting through the corporate jargon and truly understand the mechanics behind the market's most important reports, make sure to follow the show for our daily earnings coverage. Thanks for joining us, and we will catch you on the next deep dive.